Welcome to Resilience and Resolve with Lance Drury.
Welcome to Resilience and Resolve with attorney Lance Drury. Lance has spent more than 30 years helping individuals and small business owners resolve serious IRS tax problems. I'm Lisa Mosbey, and today we're talking about what happens when the IRS asks for a full financial picture. In many cases, the IRS requires taxpayers to disclose their income, expenses, and assets through a financial statement commonly known as IRS Form 433. Thanks for joining me again today, Lance.
Well, how are you today, Lisa? It's always a pleasure to be with you.
Thank you so much, sir. I'm always intimidated by talking about IRS stuff. The forms are complicated, and I hope we can shed some light on this for our audience today. Lance, at what point in an IRS case does the agency usually request the financial disclosure through something like a Form 433?
They're going to do that all the time if you're looking to pay for less than the full amount. If you're going to pay the full amount back, which most of my clients don't, but if you just want to pay the full amount back, then you don't have to disclose your income and your assets. The purpose of that 433 is to see what your ability to pay is. So, in every case where you're seeking to pay less than the full amount back to the IRS, whether it's an offer in compromise, a partial pay installment agreement, or to be placed in financial hardship currently non collectible, you have to prove to the IRS that you don't have the ability to pay it all back. Now, there are two different kinds of 433s. And actually, there's more than that. There's a 433B if you're a business, there's a 433A if you're an individual, and you have a revenue officer or a settlement officer in your case. But if your case doesn't have that much liability and you're in the automated collection system, they're going to request what's called a 433F. The thing is, the A is much more extensive than the F. You get a revenue officer in your case, they're going to want a lot more documentation than what the automated collection system is going to require.
And is it just that Form 433 that the IRS requires, or are there other things that it requires before considering certain resolution options?
Well, the IRS is going to require, if you're in the automated collection system, that you have to prove up certain categories of expenses. Because what the IRS does is there's a thing called the national standards. For example, for every county in the United States, the IRS says this is what we're going to allow for housing and utilities based upon the number of people in the household. If your number exceeds that, and most of the time it does, because I think that national standard for housing and utilities is arbitrarily low, they're going to want documentation to prove up the expenses. So what are you going to have to do? Because anybody can put a number down, so the number's meaningless. You got to have the documentation. So we have to go through bank statements, credit card statements, debit card statements to prove up those categories of expenses. And invariably, guess what? The number on the form doesn't match the documentation. So you got to use the documentation because that's all the IRS is going to give you. And so, it's a lot of work for the taxpayer. It's a lot of work for us. But if you want a deal out of the taxing authority, out of the IRS, that's what you're going to have to do to get a deal with the IRS.
And I know, Lance, you've worked with many clients who had to complete these forms. Can you share a situation where preparing the financial disclosure carefully made a difference in how the IRS handled the case?
Well, I don't know if there's a difference in the way the IRS handled the case. Nothing comes to mind readily here about that. But it's all of these. And the things that you can do is you can then give your client advice on how to structure their assets and their expenses so they get a better deal out of Uncle Sam. I'm going to give you one small example. Several years ago, I had a woman that owed over $40,000. We went through the financials 3, 4, 5 times because we got to get the numbers right because the taxpayer is submitting those under penalties of perjury. So I called her up one day and I said, "You need to go out and buy a new car." She goes, "They're going to let me buy a new car when I owe them all this money?" I said, "You got a car with 200,000 miles. A reliable vehicle is a necessary and reasonable expense in determining your ability to pay this tax liability back to the IRS." And so, you know, if I had set her up for $600 a month, which is what it showed that she could pay, car breaks down, she's got to pay the repair bill. She wouldn't have money left over then to pay the IRS her payment for that month. So she went out, got a new car. The payment was $500 a month. We set up a deal with the IRS for $100 a month. The statute on collections only had 4 years to run. So that's $100 a month for 4 years. She paid less than $5,000 over time on a $40,000 plus debt. So that's one of the things that we can do from time to time to get the taxpayer a better deal.
Wow. And we, as lay people who don't understand the tax law necessarily, need help walking through this. I can see exactly how you could support your clients. What kinds of assets and financial details tend to raise the most questions when the IRS reviews a Form 433?
Well, if you owe the IRS a lot of tax dollars, they're not going to be very happy if you're driving a Mercedes Benz or a Jaguar or something of that nature. So, they figure you owe all this money. I mean, I had a doctor once, and he had a contract for sale on a $750,000 home, and he couldn't understand why the IRS was upset with him when he owed them hundreds of thousands of dollars. So anything where the expense is huge, you got a big car expense or you got a big mortgage expense, those types of things are going to raise eyebrows with the IRS. I've had clients that didn't understand, they weren't going to get, the IRS wasn't going to allow them to go on vacation. They could go on vacation, but the IRS is not going to consider that expense in determining their ability to pay. Our magazine subscriptions or things like that, although I do think that under the miscellaneous, that sometimes you can claim those magazines. But if the expenses are enormous for a particular category, that's really going to cause a red flag. And the IRS isn't always going to give you the total amount of that expense because of how big it is and the fact that you owe them money.
And then, Lance, how does the IRS use the information from this financial disclosure when deciding on payment plans, settlements, and other resolution options?
Well, they're going to go through the list. They're going to see what's allowable. They're going to add up the expenses. They're going to add up your income, not just your wages, but if you've got any interest income or anything of that nature coming in on a regular basis. And they're going to see, okay, what's the difference? And that difference between your income and your expenses, they assume that that's your ability to pay them back. I tell everybody, there's money left over at the end of the month after you pay the household expenses, the IRS wants it.
So, what mistakes do people make when they try to fill out these forms on their own?
Well, nobody fills them out right. They're confusing, they're complicated to the average individual. So, that's why we have to go back and forth 3, 4, 5 times. Sometimes you can tell that people are just guessing because they got round numbers, and we know then that they're not really spending the time to see what their actual utilities are, to see what their actual other expenses are, their food, whatever. And so, people make the mistake all the time. They don't put down the right number. And when we go to ask for documentation for certain categories of expenses, that's when we find out that they're not putting in the correct amount.
So, Lance, for someone who's listening and they may have received a request from the IRS for financial disclosure, what should they understand before submitting that information?
Well, they have to understand that, they're submitting that, as I said, under penalties of perjury. So they've got to make sure they're just not guessing what their expenses are. They need to take the time to find out for sure what their expenses are. So, for example, your utility bills. It's going to vary during the years depending upon whether it's the summer or the winter and the types of whether you have electric or gas. So I tell everybody, go back to your utility company and get a printout of what you spent each month for a year and then divide that total number by 12 so that you see what the average is on a monthly basis. So that's the types of things that people need to be concerned about. You've got to get those numbers right. And when they're working with us, I tell them you not only got to get them right because you're submitting those numbers under penalties of perjury, but guess what? You give us bad numbers, we're going to give you bad advice. So if you want the best possible strategy to resolve your tax problems, you got to give us accurate information.
Do you have any recommendations on how people can keep track of this throughout the year so that they're not scrambling at the last minute to get all these pieces put together and maybe just assume some numbers that they don't actually have documentation for?
Well, I can give you the best example I can give you. 70% or more of my clients are self-employed. Those are the people that get in trouble because the taxes aren't automatically taken out. And so one of my first questions in an initial consultation with a business owner is, do you have a separate bank account for the business? And if they don't, I tell them to go out and do that. Because how do they know, if they're putting their personal income in there, paying personal expenses, then it's going to take them forever to find out what their actual profit is from the business. So set up a separate account, know what the number is at the beginning of the month. Then at the end of the month, if you deduct that number from the beginning of the month, then you know exactly what your profit is. Do not commingle your personal with your business. Set up a separate tax account. That makes it easier when it comes time to negotiate with the IRS.
So, Lance, follow up question from that. Do we have to have separate checking and credit card accounts, or are there penalties if you commingle your funds as an entrepreneur or a solopreneur?
Well, not with the IRS, but the state. When they go through these audits, we have found all the time there's a Records Act at the state level, and they're going to require that at the state level. And of course, there can be repercussions for that if you don't abide by the state statutes. But the IRS is not going to penalize you, except in this respect. I have seen people that we're trying to deal with at the IRS say, I can't give you a resolution because I can't make heads or tails out of what's business and what's personal. So it does penalize you at the IRS level in that regard.
And then my last question, here's where we'll wrap up. I know that typical estimates for your IRS taxes are done quarterly or 4 times a year. Would you recommend that people do it more often than that, maybe monthly, if they're having some challenges on staying up on their tax liabilities or staying current with their tax liabilities?
Absolutely, because if you wait till the end of the quarter, you're going to spend the money. Here's the classic example. Realtors have 4 times the national average of tax problems because they get a big commission in the first month of the quarter, nothing in the second and the third month of the quarter. And then guess what? They've spent all the money when the tax becomes due. So I tell them, when you get that big commission, you send 20 to 25% to Uncle Sam for current year's taxes. That does 2 things. It ensures you're going to be compliant moving forward, and we can get you a better deal on the back taxes, because if you're actually making those estimated tax payments, that's an allowable expense in determining your ability to pay back the taxes.
Very insightful today, Lance. Thank you so much.
Thank you.
Thank you so much for listening to Resilience and Resolve with Lance Drury. Financial disclosure is one of the most important steps in resolving IRS tax problems, and providing accurate information can make a significant difference in how a case moves forward. If you're dealing with IRS tax issues and want guidance before submitting your financial information to the IRS, visit lancedrurylaw.com. Be sure to like, leave a review, and subscribe to the show so you don't miss the next one. We'll see you there.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.